Hello everyone, good morning and welcome to today's lecture. So today we are going to discuss about division 2 of schedule 3. Till last lecture we discussed in detail the division 1 portion. Okay, today we will be discussing in detail the division 2. Now division 2 is basically applicable to the financial statement for companies whose financial statement are required to be prepared in accordance with Ind AS. Okay, so basically, if Ind AS is applicable to the company, then they are required to follow division 2. Meanwhile, I'll proceed, and also you can post your doubts, comments, or questions for the previous lectures or for the any of the topic that we have discussed till now, and I'll be taking up as and when they will come. Okay. Oh, so let me start. Yeah. How will I proceed here is I'll take up the study module reason because it's very extensive. It covers all the details. Okay, I'll explain it from there. Also, I'll show you the live financial statements for the Ind AS which are there, and I'll also highlight the areas where there is an amendment or there was new section or new disclosure requirement. So also I'll request you to please you also start marking up with me so that this will help you at a later stage, at a later point in time when you will go for revision of this particular topic. Okay. So as I said, division 2 of schedule 3 is applicable to companies to which the Indian accounting standards are applied. Indian accounting standards apply. Okay, so now if a company is required to prepare its financial statement as per Indian accounting standards or as per the applicable Indian accounting standards, then they need to comply with the division 2 over here. Now compliance with act or you can say compliance with Indian accounting standards or any disclosure requirements which are there for in the Indian accounting standards. Okay, so it may happen at a time, for example, Indian accounting standard Ind AS may require you to disclose something additional. For example, employee benefits, they might require you to disclose various items in respect to the employee benefits. So in that case, what division 2 or schedule 3 talks about is that when an Indian accounting standard says that okay, you need to disclose additionally as per the accounting Indian Ind AS, then this schedule stands amended and you are required to disclose that particular portion in such a way, in that way. So disclosure requirements of Ind AS Act will be given preference compared to this division 2, and then you need to follow division 2 for the rest of the disclosure. So you can say you need to follow act plus Ind AS. Okay, you need to follow act plus Ind AS for disclosure requirements, and then you need to see division 2. Okay, now why? Reason because division 2 itself says that okay, as applicable, like in case of requirements of act and including Indian accounting standards as applicable to companies require any change in treatment or disclosure, in addition, amendment, substitution, or deletion in the head or subheading, or any changes in the financial statement, okay, then such requirement, okay, the same shall be made and the requirement under this schedule stands modified accordingly. Means that if Ind AS or AS says that, if Ind AS or Act says that you need to disclose this change, okay, then you need to disclose that particular item or particular requirement in the way it is provided in the Ind AS or Act, and division 2 will stand amended accordingly. Means you need to understand, okay, there is a change or this disclosure is also required by division 2. Okay, so first preference Act or Ind AS, then goes to division 2. Now also this requirement of division 2 is not in substitution but in addition. Means what? That whatever NDS or act is requiring you to disclose, you need to disclose. Over and above that, you need to follow division 2. Means, let's say 3 points are required to be disclosed by NDS on employee benefits, and division 2 requires you to disclose 3 more points. Then it is not a substitution that either I disclose these 3 or either I disclose these 3. No, you need to disclose 3 of NDS and 3 of division 2, means total 6 points. Hypothetical example. Okay, so these requirements are in addition but not in substitution. Okay. Yeah. Now, okay. This is, I'm talking about the amendment over here. Reason because the words were something different before. Okay. Now, if you see the point number 5, which talks about rounding off, which talks that, okay, when you are required to round off the figures. So earlier, as per the requirement, okay, earlier, as per the requirement, the rounding off criteria was based on my revenue. Now that requirement has been changed, or there is an amendment in that particular requirement. And just a minute. Screen is stuck. Just give me 1 minute. Okay, yeah. So earlier, this rounding off was dependent upon the turnover of the company. Okay, so the word total income, which you are seeing over here, this word total income was earlier was turnover of the company, but now it has been amended and it is now total income. So your rounding off now will depend upon the total income which is there in the company's financial statement, not on the basis of turnover, which was earlier the case. Okay. Now what rounding off talks about? Okay, less than 100 or less than 100 CR. If your total income is less than 100 CR, nearest to hundreds, thousands, lakhs, or million, you can round off. If it is more than 100 CR, then nearest to lakhs, millions, CR, crores, or you can round it off. So once if you use, for example, let's say I use a measurement, let's say in lakhs. I cannot disclose my PNL into lakhs and balance sheet into CRs. Okay, or I cannot do that. Okay, my balance sheet will be in millions and my PNL is in lakhs because the number are a bit smaller over there. No, I cannot. I need to apply a single measurement unit across all the financial statement and their notes. So if I apply millions for rounding off or for showing the number in millions, I need to show the numbers everywhere in millions, not only on one statement but in all the statement, all the notes, everywhere. So it is required to be applied uniformly. Okay. Unit of measurement, you need to apply it uniformly across the financial statement. Okay. So we already know that we are required to disclose corresponding numbers, comparatives of immediately preceding reporting period. So corresponding amount for immediately preceding reporting period. Okay, except in case of first financial statement. Except in the case of first financial statement, because you will not have any preceding number. So other than that, we are required to disclose immediately preceding reporting period financial numbers. Now materiality. So act will disclose, or act will this division 2 will talk about materiality. So at point in time or at some places you will see the word material being used. What is material? Now material you need to understand from size of your balance sheet or the P&L or the nature of the item. It depends upon how it is impacting the decision of the users. If we disclose separately, then how it will influence the economic decision of the users. So on the basis of that, we need to decide something as a material or non-material. Okay, then okay, so something which was not there in division 1, statements of changes in equity. Okay, we were seeing about balance sheet, statement of profit and loss account in division 1, but in division 2 there will be statement of changes in equity also that we are required to disclose. Okay, now starting with division 2's financial statement. So then part 1 talks about balance sheet. Now in division 1 we saw the balance sheet used to start from equities and liabilities. Here we are seeing that balance sheet is starting from non-current asset. Okay, the balance sheet is starting from non-current asset. So first we will be dealing the asset portion in division 2, and then we deal with the equities and liabilities in division 2. Hope I'm clear. Okay, so also I'll show you simultaneously the India's balance sheet. See guys, the India's balance sheet that I have with me, okay, is of financial year ending 31st March 2020. Let me check if I just give me 1 second. So I have a balance sheet of financial year 31st March 2020. Okay, it is again I have a 21 also. So we will be discussing both simultaneously, as in as in when which example is suited best. Okay, okay. Then starting with first asset. So assets, again you need to bifurcate between two categories in balance sheet: non-current and current assets. So first one is your non-current assets, and then you disclose current assets. We'll see the definition of current and non-current in a while, but this is how the bifurcation goes: current and non-current. When I say non-current, non-current includes plant, property, equipment, PPE, capital work in progress, investment property, goodwill, other intangibles, intangible under developments, biological assets, financial assets which are of non-current nature like investment, trade receivables, loans, deferred tax asset, whether it's a net position, if it is a net position asset, then asset over here, and other non-current assets. Clear? In current asset, we talk about inventory, then financial assets like investment, trade receivable, cash and cash equivalent, bank balances, loans, others, if there is any other which is not not to be not falling under any other of the category for financial asset, current assets, current tax asset, and other current assets. Okay. This was the total asset size. Let's go to the notes and understand in detail what these mean. Changes in statement of changes in equity, I'll be dealing once I'll reach to the equity side. I'll take up at that point in time. Okay. Yeah. General instructions which talks about what is current, what is non-current. Okay. Now, when I say current, or what do you mean by current? When I say current asset, current asset means that if it is expected to realize within normal operating cycle, same like my division 1, it is hold for purpose for trading. Okay, it is expected to realize the asset within 12 months or The asset is cash or cash equivalent unless asset is restricted from being exchanged at least for 12 months. Okay, so if these conditions satisfy, then it's a current asset, otherwise it's a non-current asset. Same way for current liability, liability to settle within normal operating cycle, liability primary for purpose of trading, liability is due to be settled within 12 months, and it does not have an unconditional right to defer settlement of the liability for at least 12 months. Okay, then the liability will become current, otherwise it will be non-current. These were the things, and we also saw what is trade receivable, payable, same as the division 1, no difference. Okay, now coming to plant property and equipment. Plant property and equipment, remember in division 1 what we saw? In division 1 we saw that okay, we need to classify plant property and equipment on the basis of type of asset first, like land, building, plant, furniture, fixture, vehicles, office equipments. Till this point of time we saw okay, now there is one more additional you can say classification given in the division 2. This is division 2 specific. Okay, bearer plants based on the NDS classification. Okay, and others that was also there. Okay, now if asset is under lease, you need to disclose it separately. Number 2, a reconciliation of the gross and net amount at the each class of asset at the beginning and at the end, and any change of amount due to revaluation. If change is 10% or more in the aggregate net carrying value of each class of property, plant and equipment, then you need to disclose that also. So here the words are 10% or more of the net carrying value. Remember, okay, for each class of plant property and equipment, then you need to show that change also in due to revaluation. I hope I am clear. Okay, so this is how the your portion of, you can say, plant property and equipment looks like. Okay, now let me pull up one of the live financial statement. I'll suggest please don't go on the names of the companies that I will be discussing over here. That is just for the purpose of you can say reporting, nothing much. Just give me 1 second. Okay. So just 1 minute. Okay, now see, this is a live balance sheet that we are talking about. Okay, how this is disclosed is same way. Remember I told you that okay, first non-current asset, then in non-current asset you will see multiple bifurcations like plant property, equipment, capital work in progress, investment property, then intangibles, financial assets, investment and other financial asset, deferred tax asset, income tax assets net, and then other non-current asset. Now we'll see each one by one. Okay, now first we'll go to schedule 3, which is plant property and equipment. These are all notes. Okay. Plant property and equipment. Remember in the last example, last time also in the last lecture, I showed you okay how the reconciliation is prepared. This is the reconciliation same way, which is required by the division 1 also, required by the division 2 also, which talks about the opening, closing, additions and deletions, the reconciliation, plus classes of asset like land, office building, factory building, plant and machinery, furniture, fixture, office equipment, vehicles. If they have an aircraft, then aircraft. Also, it required, remember that now we saw that we are required to show separately the lease asset held under lease. So right to use of asset and for lease asset, land and building separately. Then you have a total plant property and equipment. Okay. This is the second portion which talks about the intangibles. We'll see in a while intangibles also. But same way, if I say intangibles, computer software, mine development rights, and their reconciliation, opening, closing, during the year additions, during the year deductions or revaluations, if any, and the final balance closing as on the period with a net total carrying value. Remember we discussed in last time in the lecture how we calculate the total net carrying value. So this is how a plant property equipment are disclosed. Okay. So property, plant and equipment, this is how it is required to be disclosed in financial statements. Now someone will ask, okay, whether I make a vertical schedule, horizontal schedule, can I change the format of schedule? Answer is yes, because division 2 or schedule 3 prescribes minimum disclosure requirement. It doesn't say that okay, you need to prepare a horizontal schedule or vertical table, horizontal table. No, it is upon the use, it is upon the company how they disclose this information, but they are required to disclose this information at a minimum, and they are required to disclose this information in such a way that it should be understandable. Okay, so that's the requirement. I hope I clear. Any doubt till now? No doubts? Okay, good. I think I'm clear. Then let me move forward. Then the next part is my investment property. So for investment property also, what I'm required to do is a reconciliation of gross and net carrying amount of each class of property at beginning and at the end of reporting period, showing additional disposal acquisitions through business combinations or other adjustment related to adjustment related to depreciation and impairment or reversal. These I am required to disclose. Same way we saw just now for the plant property and equipment, nothing different. Goodwill, again same, a reconciliation of gross and carrying amount at the beginning and at the end of reporting period, addition, impairment, disposal and other adjustment. Same we saw for the property, plant and equipment. Also here, also applicable also here. Intangibles. Intangibles, you are required to bifurcate between brand, computer software, mastheads and publishing titles, mining rights, copyrights, patents. Then recipes, formulas, license, and others. Again, same way. Reconciliation of gross and net. Okay, amount showing addition, disposals, and everything. Same as property, plant, and equipment. No difference. Okay. Biological assets. Again, it's on the same line. Reconciliation. Okay. Investments. As we saw in our division 1, it is on the same line. Okay. investment in equity, preference, government trust and securities, debentures, bond, mutual fund, partnership firms, and other investments. Again, you need to provide whether it's a subsidiary, associate, joint venture, or structured entities in which you have done the investment. Plus, you are required to show if it is in the partnership firm, then name of the firm, partners, total capital, share of each partner shall be disclosed separately. So if it is in the partnership firm, you need to disclose the details of partnership firm. Okay. Then again, you need to disclose between quoted investment, unquoted investment, and aggregate amount of impairment in value of investment. So this is how you need to provide details of investment. Sorry, I think my screen was freeze. So we saw investment properties same as PPE. Goodwill, again same reconciliation. Intangibles, these are the classification plus our reconciliation. Biological assets, reconciliation. Investment, so investment you need to show first classification, then you need to show okay relationship, and then you need to show quoted or not. So three bifurcations for investments. Okay. First, you need to do classification: equity, preference, governments and debentures, mutual fund, partnership firm. Number 2, relationship with the entity where you have invested. Number 3, whether quoted at market value, then what is the market value, quoted investment and market value thereof, unquoted investment, and whether there is an impairment, then total amount of impairment. Clear? Let me show you one example. See, remember in the last lecture also we discussed for the investment how they are required to disclose. For example, let's see, 50,000 shares, equity shares of this particular company. Okay. Now, if you see, this particular company is falling under the head of investment in equity instrument of subsidiary companies. So equity instrument, subsidiary companies. So I have done classification also. I have done provided the relationship also. I have also provided these all are unquoted investment. So the third condition, quoted unquoted, is also done. Clear? Plus the investment details that I am required to disclose. How many shares? What is the how many shares for the current year? How many shares for the previous year? Remember, we saw in the starting that okay, you need to provide comparative of the previous immediately preceding financial reporting period. Immediately preceding reporting period over here, you are required to provide the comparatives. Not even the case of amounts, but if you are disclosing number of shares or any other details, it is also required to be disclosed for the immediately preceding comparative period. So 50,000 shares earlier, 50,000 shares now also, both are there. Then what is the face value of each share? What is the amount? Like this way. Clear? Then if you see over here, yeah, investment in equity instrument of jointly controlled entities, equity instrument of associates, preference shares of subsidiaries. Okay. Then investment in debentures, investment in limited liability partnerships. Now these are the partnerships. So remember, for the partnerships, we are required to disclose the detail of partnership firm. Refer D 6D. See, above investment includes investment deemed investment on account of corporate guarantee issued to these and their subsidiaries. Yeah. So they are talking about okay, the investment which is disclosed above is a part of a subsidiary that as a part of a guarantee. So that's the they have provided. Okay. Plus this partnership details and all those things are also given in disclosure in related parties schedule, which is separately given below. I'll come upon to that particular disclosure also. Okay. Then see, unquoted investments in other equity instruments measure at fair value. Okay. Unquoted investment measure at amortized cost. So if there is a change in measurement value also, they have disclosed separately. Clear? Okay. Then trade receivable. The next one was trade receivable, but still we are talking about non-current. We are not talking about current asset. We are talking about non-current asset. Unlike your division one, what you are required to do is in division one, we used to show that okay, secured considered secured, good, then unsecured, and then there was one doubtful. Okay. However, over here there is a bit change. Okay, the change is you need to provide, okay, whether considered good, secured, yes, considered good, unsecured, yes. Then the third is additional, which have a significant increase in credit risk and credit impaired. Over there we were talking about doubtful. Here we are talking about bit change in the terminology, but things are same. We are talking about which have a significant increase in the credit risk and credit impaired means they are already gone. Okay, so 3 or 4, secured, unsecured, significant increase in credit risk and credit impaired. Clear? Okay. Then if there is a doubtful, then if there is something doubtful and you have created a provision or allowance for that, you need to disclose it separately under the relevant head. So for example, okay, for example over here, see, trade receivables. Now over here, if you see unsecured considered good, unsecured credit impaired. So these two numbers are given. Then they have provided allowance for credit loss. This is only related to your this one unsecured. So they have provided over here what is the credit loss over here and the net number which is reported over here. So allowance is disclosed separately for each class of trade receivable like this way. Okay. Above includes due from related parties and unsecured goods considered good. So this is how it is given. Okay, so for related party also they are providing different separate disclosure. The reason behind is it's required by the division itself. I'll show you. Okay, see over here, that's due by director or other officers. That's due by director, other officers of the company, and they are involved in this. So that is required to be disclosed separately. So when there is a director or any other officer involved, you need to show separately. Okay, so that's a disclosure requirement for the related parties also. Okay, now this is the amendment portion, guys. This is was not there earlier. This is the new. For trade receivable outstanding, a schedule is required to be given. Okay, schedule of my aging is required to be given. Remember in previous lecture we discussed about how we are required to provide the aging. What is the purpose of aging? Same, in the same line, just your heading will differ based on these trade receivables headings. Your current heading will also differ. So for example, undisputed trade receivable considered good. It was there last time also. Undisputed trade receivables which have significant increase in credit risk. Remember, there were last time trade receivable considered good, and see, Earlier we were talking about in division 1, undisputed trade receivables considered good, undisputed trade receivables considered doubtful. Reason because for the trade receivables we were using these kind of bifurcation: secured considered good, unsecured considered good, and doubtful. Okay, now in division 2 we are using a bit of different terminology, but they mean same. Just the wordings are different, but they are same in nature. What we are doing is considered good secured, considered good unsecured, and instead of doubtful we are writing, okay, we have bifurcated doubtful in two cases: significant increase in credit risk and credit impaired. So we have bifurcated doubtful in two scenarios: one where there is a high chance of going doubtful, and one which has become doubtful. Credit impaired means that is gone. Okay, so if the bifurcation in trade receivable in such a way, then I need to change the bifurcation in aging schedule also. So that's the thing over here, that undisputed considered good, undisputed having significant increase in risk. Clear? Okay, same way for my just give me, yeah, same way for the rest of the things also, like undisputed trade receivables where the credit impaired is there. Now this was the undisputed portion. Disputed, same, considered good, significant increase in the risk, and disputed, credit impaired. You need to provide aging of this particular trade receivable from the due date of payment. Now if the due date is not available, due date of payment is not available, then you can take the date of transaction. Same like division 1, there is no change in that. No change. Just the change is over here. Change in the headings, that's it. There is no change in the concept over here. I hope I'm clear. Okay, so this is the important one, and this is also amendment. This can be, very a lot of questions can be asked on this. For example, I'll show you one of the question over here. I'll write it down. Let's say there was a company, ABC Limited. Now ABC Limited was preparing financial statement for financial year 21-22. Okay, now they are required to comply with the requirements of revised schedule 3. Now while preparing the financial statement, what ABC Limited did is ABC Limited disclosed the trade receivables in the below format. Particulars. Let's say I'll follow the schedule 3 division 2 itself. Less than 6 to 1. Yeah. Less than 6 months. 6 to 1. 6 months to 1 year. 1 to 2 years. 2 to 3. More than 3 years. Okay, let's say this is the class. This is a bifurcation given. Now again, undisputed, then considered good, then my significant increase in credit risk, and credit impaired. Let's say these are the 3 bifurcation for undisputed. There is nothing disputed. Okay, as of now there is nothing disclosed on the disputed part. Let's say 100, then 150, then 50. This is the hypothetical example I'm talking about, just to explain you the concept over here. Okay, 20, 10, 10, 5, 0, 0, 0, 10, 5, 10. Okay. Now this is the scenario. This is how they have disclosed it. Fine, clear. Okay. Now, while calculating the aging or while calculating this amount, what the company does is company, okay, while calculating the amount, company reduced the, not reduced, sorry, company added up the GST amount also in aging schedule. Okay, so these numbers were with GST. These numbers are with GST. Okay, and the total of balance sheet trade receivable versus aging schedule were different. Now let's say the total which was there in the balance sheet for the trade receivable non-current is different than the total of aging schedule. Reason because these amounts are with GST. Okay. Also, the aging which has been calculated, the aging which has been calculated is from 6 months of transaction date. So what company did is company took a due date. This is a due date. Company took a due date which is transaction date plus 6 months. Okay, now this was not the case. So for example, they have taken a generic period. However, this is not the case in reality because each and every trade receivable has been provided a separate credit period, not a generic 6 months. So they have done this way, and on the basis of that, they have calculated the aging. Okay. So just a minute now. Then I'll just change up a few things. Okay, now you tell me in the current example whether these two things, the company which has done these two things, is appropriate or not. Simple. First, they have taken a GST amount while showing the aging schedule because it is showing the appropriate how much they have billed and what is the aging of that billing. However, it is creating a difference between the total which is disclosed in the balance sheet and aging schedule. Number two, they have taken a generic 6 months period of timeline while calculating the due date, and on the basis of that, they have disclosed this particular aging schedule. Okay, you tell me both of the cases are correct or incorrect. Pretty simple. Vidula, in a while I'll take up your question. After this particular example, I'll take up your question. So come on, guys. Whether the company is appropriate while in both of the cases or not. One with GST, second with a generic period of due date. Come on, guys. Can I take a generic due date period by adding certain months into the date of transaction when due date is not available? And can I show with the GST amount in my aging schedule? Simple. correct there, appropriately correct. Come on, guys. Okay, correct. Okay, come on, guys. Come on, I'm waiting for your answer. So, one in first example or first question with GST, correct or not? Second, a generic period for calculating the due date. Correct, Vidula? I hope the answer is for both of the cases. Your answer is for both of the cases. Come on, guys, come on. Okay, so I'll tell you over here. Now, the prime condition for this aging schedule is whatever schedule you are preparing, okay, the amount should tie with your balance sheet amount. Amount of aging schedule should match with balance sheet amount. If you are disclosing in the trade receivable schedule, like where you are showing bifurcation, secured, considered good, secured, considered good, unsecured, significant increase in credit risk and credit impaired. If you are showing that amount without GST, then you need to prepare the aging schedule also without GST. And also, you do not include GST, like because you take a credit of that. Okay, so you do not include that particular amount of GST for which you already take a credit. That is, you do not disclose as a part of trade receivable. If the credit is available, then you don't disclose it as a part of trade receivable, unless and until there is no credit available. But again, when the credit is available, that does not become part of your trade receivable. Number two, so this is incorrect. Number two, generic period for the calculation of due date is incorrect. Reason because each and every debtor has a different credit period. So if that credit period or due date is not available, you need to take from the date of transaction. You cannot take this generic period. Now, if I take some generic period, let's say in example, this 6 months, my aging for the first 6 months will be 0. Reason because I'm adding up 6 months and it is giving a aging of from 6 months. So for the first 6 months, aging will come as a 0. So that's why either take from the date of due date of payment or date of transaction. If due date of payment is not available, invoice wise or data wise, then you need to take the date of transaction. You cannot add like a generic date one. Okay, hope I'm clear. Harshit, because you take a credit and you do not disclose in the trade receivable, for which if you are taking a credit, okay, but again that you need to see. Okay, if you are disclosing with, then you need to see the point is here is it should be aligned with what I am showing in my schedule. If I'm showing with schedule, if I'm showing in schedule, then it should be with the aging should disclose the same way. So the point is, if you are showing X amount in the schedule or in the balance sheet, you need to show X amount in the aging one also. Clear? Okay, let me move forward then. Coming to the next point, loans and loans for non-current assets. Okay, now Vidil, to your question. Okay, you want to understand what is unquoted investment disclosed at the fair value, and when we are required to disclose amortized cost. So this is as per the Ind AS. You need to see Ind AS with respect to the disclosure of investments. Okay. It may be financial asset, how we disclose financial asset. There are various multiple methods available to disclose a financial asset. So you need to see the respective Ind AS, which is not part of the Schedule 3 as of now, because they have a separate guidelines when to disclose in which way. So I'll suggest you to refer to the Ind AS over there. Okay. Okay. Now coming back to the loans and advances. Loans. Okay. And I'm talking about non-current over here. Loans shall be classified as loans to related parties and other loans. Loans to related parties and other loans. Then loans receivable again you are required to classify same as a trade receivable. Considered good secured, considered good unsecured, which have a significant increase in credit risk and credit impaired. Then you need to provide sub-classification. That sub-classification, we already, this one is there. Okay. Now this sub-classification, if you see the classification given in division 1, which talks about secured, considered good, secured, unconsidered good, and doubtful. But over here, you need to provide the sub-classification: secured, unsecured, have significant increase in credit risk and credit impaired. Okay. Then you need to provide for allowance for debt, separate details for allowance for bad and doubtful loans. So for example, if you have made a provision, you need to disclose it separately for each class of asset, for each class of loan, basically, that allowance for doubtful loans. Okay. Same as my trade receivable. Again, loans due by director and other officer of the company, or firms due by firms or private companies in respect of which director or partner or director or member is a partner should be separately disclosed. Sort of where the director or officer or any person of the company is involved, you need to disclose separately. Okay. Other financial assets. Now again, why I'm focusing on this area is because there is a change compared to the last time. Okay. Last time means there is an amendment in this particular area over here. Okay. Other financial asset. Earlier, this category, other financial asset, you can say was not present in the non-current. Okay. It was not present in the non-current. Immediately after loans and advances, it was bank deposit more than 12 months maturity. So this particular item was not there till last time. Reason because only this item, bank deposit more than 12 months maturity, was present. Now they have added these two also. Okay, they have added these two also. Means now security deposits will be part of your other financial asset in the case, means in the heading non-current asset. Security deposit now will be part of your other financial asset under the head non-current asset. Earlier, security deposit was disclosed. So earlier, when we used to disclose the security deposit, that were part of loans, okay, which was part of current asset, or we used to disclose security deposit as a part of loans as a non-current asset. So earlier, security deposit was disclosed over here. Either it was part here, security deposit, earlier security deposit was here, either under the head of loan, okay, or in the current assets under the head of loan. But now a separate other financial asset has been created under which the security deposit has been shifted. I hope I'm clear with this particular bifurcation. Okay, so there is an amendment with respect to the security deposit. Correct, Harshal. Yes, you disclose it, but I'm saying my point was, if you disclose, then you need to disclose at the both places. If because of some arrangement you do not disclose, then you need to do not. It means you need to accrue at both places. That's an amendment. That's the amendment over here, Shrinidhi. Yeah. Okay. Yeah. So this is a particular amendment. Important one. Security reports part of other financial assets now. Okay. Then other non-current assets, which may include your capital advances, advance other than capital advances, like advances maybe to some parties, then advances to directors and other officers of the company. Then like it's whether you can say severally or jointly liable in respect of any director or partner. So if any director or partner of the company is involved, then advances to that director or partner need to be disclosed separately, and other advances. Okay, other any non-current asset. Now, when I say other non-current asset, means it's not falling under the category of any of the above one. So that will fall under the other non-current assets. Okay. Any further doubts? Okay. So till now we disclosed about the assets. This was particularly about the asset side, which included current, non-current both. Okay. Sorry, this was particularly the non-current asset. Now we'll discuss the current asset portion over here. I hope I'm clear. Okay. Current asset first, inventory. Okay. Inventory will include raw material, work in progress, finished, stock and trade, stores and spares, loose tools and others. As same way, my division one. Okay, goods in transit shall be disclosed separately under subhead of inventories, and mode of valuation shall be stated separately. Now, let me show you one example for the inventory. See, so first over here, valued at lower of cost or NRV. That is a method of valuation that has been disclosed. Then traded goods or stores and spare part, whatever inventory is applicable over here. If it is a trading concern, then they might not have a raw material WIP. They will have a traded goods and stores and spares. That's the classification. Okay, goods in transit includes goods in transit of this much CR, and last year it was this much CR. So goods in transit detail. For security and hypothecation, refer note 21 and 24. So if you have pledged any of the security under any of the inventory under security or hypothecation, then you need to provide disclose the details separately. So they have provided a note for that also. Clear? This is how the inventory looks like. Inventory disclosure is made in the financial statement. Then coming to the next, investment. Similar than this we saw in the non-current. Similar nature. Similar disclosure. Okay. Similar as non-current. There is no change. Classifications. Then relationship. Quoted, unquoted. Three things. Classification. Then you need to disclose relationship. And then quoted, unquoted. for investments. Clear? Same way my trade receivable for current, as we saw for non-current, same as non-current. Okay. Considered good secured, considered good unsecured, which have a significant increase in credit risk, credit impaired. Again, aging is required to be given. Allowance for bad and doubtful debt to be disclosed separately, where director and officers are involved, disclosed separately. Again, aging same as above. And this is also the amendment that for aging. Okay, aging is an amendment. There is no change in the aging we are talking about over here that we saw earlier. Same, on the same line, no difference. Okay, cash and cash equivalent, balances with bank, checks on draft on hand, cash on hand, and others. Same. Loans, similar to what we saw earlier. Similar what we saw earlier. There is no difference. This is the classification for the loans. Remember, the classification in division 1 was secured good, secured, unsecured good, and doubtful. Here in division 2, whenever we are talking about classification, there will be 4 things: secured, unsecured, significant increase in credit risk, and credit impaired. Okay. Then allowance for doubtful debts, it's doubtful loans with directors or officers involved, you need to disclose separately. Okay. Now loans and advances means loans to related parties and others. In case of current asset, there is no change. Okay, in here, except for security deposit has been removed from here. Okay, security deposit has been removed from here. Except for that, there is no change. I hope I'm clear. Now, if they have removed the security deposit, where they have taken is here, other financial assets. So, other financial asset, this includes all-inclusive heading, which incorporates financial asset that do not fit into any other financial asset category, such as security deposit. So now security deposit will be shown under other financial assets, under the head of other financial assets. Clear? Same way we saw earlier for other financial assets, same way in the non-current, same way in the current. Similar on the both lines. I hope I'm clear. Okay. Then after this, after the other financial assets, the second area is other current asset. Other current asset, again, it's in a big heading. If that is, if nothing is classified or nothing is provided, if an item is not getting fit into any of the previous category, then it will fall under the category of other current asset. Okay. So other current asset, if anything is not falling under the head of any of the previous items, then it will fall under the other current assets. Okay. So it's an all-inclusive sort of heading, means That is, if item is not coming into any of the head earlier, then it will fall under this head in this way. Okay. So all inclusive heading which incorporate current head do not fit into any other category. Okay. So this was pretty much, you can say, for the asset side that we just now saw. This is pretty much on the asset side, current, non-current, both. Any doubt till now? Any doubt? Any doubt? No, Jay. Why twice given? One in the under the head of non-current trade receivables, another under the head of trade current trade receivables. So there are two current and non-current bifurcation. Especially structured entities, they are, you can say special purpose entities, somewhere structured entities, similar to special purpose entities, Vidula. So structured entities means some kind of, special purpose entities, you can say. It have a, structured entities at times have a different, characteristics, like they are restrictive one, means they have a defined object for which they are created. Okay. Then they are for a special you can say purpose for which they are, being created, or they are being, you can say, uh, they have a defined purpose. Basically, they are special purpose entities, you can sort of, you can say. If you want to further read on the structure entities, I'll suggest you refer to NDS 1110. Uh, you can refer to the NDS 1110s, or you can refer about, the consolidation of structured entities, or NDS 1112, which talks about, disclosure of interest of an entity. So in other entities, so that also contain structured entities details. So you can refer that also. J, trade receivable given twice means they have bifurcated between current and non-current. Okay. Non-current trade receivables above, and again trade receivables below. Current trade receivables below. Okay. Any doubt further? Okay. No, then I can move forward. Yeah. Uh, Now the next part is the equities and liabilities. So before going to the equity and liability, what I will do is I'll I'll also touch upon the statement of changes in equity, because that's a part. It's a similar part. Okay. Equity and liabilities start with my equity, which includes equity share capital, other equity. Okay. Now, for equity, there is a statement of changes in equity also. I'll show you with a live example rather than it will enhance your clarity. Okay. So this is a statement of changes in equity. How it is given is, first of all, remember we saw in the bifurcation equity share capital and other equity. So they provide, you can see a sort of reconciliation between opening and closing, which is equity share capital balance at 1st April 2018, then balance at 31st March 2019. During that, there is a change between, equity share capital over here. Okay. What is the change in equity share capital? Can be of any nature. Okay. If you have issued more equity share capital, or if there is a buyback or reduction in share capital, so all these changes are over here. So that changes will reflected in this case particularly, there is no change. Okay, here there is no change, and hence it is not disclosed, means there is no change has been given over here. So yeah, so balance at 31st March 2020. So they have given the movement for that and the comparative. So you can say this is comparative and this is for current period. Okay. Now for other equity, when I say other equity will include your reserves, retained earnings, reserves and surplus. So they have provided, okay, what are the other equities? Reserves, general reserve, security premium, capital reserve, retained earnings, and their movement. Okay, what was addition during the period? What is, deduction during the period? What they have transferred, like issue of dividend, tax on dividend, interim dividend, transfer to general reserve, profit for the year, OCI. They have provided all these details, if any impact. So let's say there is a transfer from general reserve. So they have provided into this particular head. So like this way, they have provided a reconciliation. Okay, a reconciliation has been given in the statement of changes in equity. Clear? So this is how you need to provide for the statement in changes of equity. I'll also show you. This is how, I showed you when there are limited number of items, because the company was having limited number of items. But when you have a full-fledged items, or more number of items, you need to disclose share application money, pending allotment, equity component of compounding financial interest, then reserves and surplus, debt instruments through OCI. Okay. Equity instrument through OCI, effective portion of cash flow hedges, revaluation surpluses, exchange difference on, translating for the financial statement of foreign operations, other items of OCI, money received against share capital, and these all become part of under of your other equity. This is for the current period, means that balance which was at the start of the current year, then if any changes are there, so these are the changes during the period, and this is balance closing. Okay, this is how statement in changes of equity is disclosed for other equity item. For share capital, we saw what was the beginning, what are the changes in share capital, restated balances if there is any, changes in equity share capital during the period, and closing balance. This is how it is required for the equity share capital. Now, other than this disclosure, there is some additional disclosure required by the respective head or particular note also for the equity share capital. Let me go to that. Okay. Other than the statement of changes in equity, additional disclosure is also required for equity share capital. That requires number of amount of share authorized, number of share issued, subscribed and fully paid up, per value per share, reconciliation of number of share outstanding at the beginning and at the end, rights and preference and restriction attached to each class of shares. Okay. Then each class in company held by its holding or ultimate holding, shares held by each shareholder holding more than 5%. So I'll write it. Number, okay, subscribed, value, reconciliation, rights, holding more than 5%, okay, share reserved under issue or under options or commitments, okay, reserved shares, now for the period of 5 years, if there is any share allotted, okay, other than for cash, like without payment being received in cash or through bonus share or share bought back, then you need to disclose that detail. So this is for 5 years. What you need to disclose other than cash, or I can say, let's say without cash, then bonus shares, and then buyback. So for 5 years you need to disclose without cash, bonus shares and buyback. Then you are required to disclose terms for any security convertible, terms of any security convertible into equity shares. So if there are terms and conditions mentioned and the date of conversion, then you need to provide that. Unpaid calls and forfeited shares. Okay, so these are the details you are required to disclose for your equity share capital. Number of shares, subscribed, fully paid up or partly paid up, value, reconciliation, opening, closing, rights of each class of share, share held by holding company or ultimate holding company, share held by shareholders more than 5%, reserved for commitments or options. In case of without cash, share issues without cash, bonus share and buyback, for 5 years you need to disclose the aggregate number of shares allotted and fully paid up. Okay, then terms and conditions for the conversion, unpaid and forfeited shares. These are the details you need to disclose. Plus, over and above that, there is one more disclosure that is required to be given. Okay, there is one more disclosure which is required to be given, that is for the promoters. Now this disclosure was earlier not present. This is a part of amendment, you can say. Shares held by promoter at the end of year, name of the promoter, number of shares, percentage of total and percentage of change during the year. Percentage shall be computed with respect to the number at the beginning of the year, or if issued during the year for the first time, then with respect to the date of issue. Okay, so you need to calculate the change, okay, based on this information, like what was the number at the beginning or first issued, then what is the closing balance as of today. Promoter means as defined under section as defined under Companies Act 2013. So details of promoters you are required to disclose separately. Name, number of shares, percentage of shares, or percentage during the change in percentage during the year. Clear? Any doubt till now for equity share capital? Okay. Jay, what I'll suggest over here is there are two ways to deal it. Okay. Now your question is, if trade receivables due after 1.5 years, will it be part of current asset after 1 year? Okay. Now two ways to look at it. When say, let's say if the balance sheet date still 1.5 year is going on, if I'm not able to receive, if I'll not receive on this particular balance sheet date, and I'll receive after 1.5 years, then it will become part of my non-current based on the definition. Okay. Then at the next balance sheet date, again I'll reassess what is the current, whether it's a current in nature or not current in nature. So again, I need to see the definition which is given. Remember, if it is getting settled within 12 months period, or if it is in normal operating cycle, or if it is like all those conditions for the current asset, if it is still satisfying for the current, then it is fine. Then I'll show as a current. Otherwise, I'll not. So at the each balance sheet date, you can say you need to refer to the definition of current and non-current, and you need to see whether it is satisfying that definition or not. Yes, Srideti, the disclosure is same on the line of division 1. Okay, the disclosure of the equity is same on the line of division 1. Clear? Okay. Clear till now, till equity? Vidula, remember when you restate your numbers, because there was some issue, so you prepare 3 balance sheet and you restate the balance at the beginning of the current reporting period because of some error which was there. So in India, there is a provision to restate your balance sheet. That is the we are talking about here. For further, you need to refer to the NDS that okay, how a restated balance sheet is prepared and how they are reported. Guys, I'll request you to read also, so that while going through, prepare the notes, read before you come to the lecture. Reason because it will enhance your understanding. You will be ready with the questions, and it will help you understanding the things. Okay. And number two, guys, please provide your feedback. Reason because your feedback is very important for us. Very important to understand what you require and what you don't. Okay. So what I do is, let's take a quick 10-minute break and then we'll join again. Okay, after 10 minutes, and we'll continue for the rest of the division 2. Nisalji, let's go for a break for 10 minutes. Nisalji, Okay, welcome back, guys. I hope everyone is recharged. Let's move forward to the rest of the part of our division 2. Okay. Okay, we saw about the equity. Now we will see other equity. Okay. Other equity, as we also see saw in our statement of changes in equity, it's on the same line. It's on the same line, nothing different. You just need to provide the details. Okay, like, okay, what are the other reserves that you are going to disclose in other equity, like CRR, debenture redemption reserve, share options, or if any other reserve it's there. So you need to specify nature, purpose of each reserve, and amount in respect of thereof. What is the amount of that reserve? Also, you need to show addition and deductions since last balance sheet, means a reconciliation that is already present. We saw in other equity, but still you need to show separately. So just let me show you one example for this schedule. Along with that, for the reserves, what we are required to do is we are required to provide details of nature of each kind of reserve. See over here, general reserve, securities premium, capital reserve, retained earnings. Okay, we have also shown, okay, what was the as per last balance sheet date and addition or disclosure, a sort of reconciliation. Again, you are showing vertically, horizontally, doesn't matter, just you need to fulfill the requirements and it should be understandable. So disclosure requirements prescribe what is minimum is required to be disclosed, but how, in which format, it depends upon company to company. Okay, then nature and purpose of the reserve. What is the purpose of general reserve? What is the purpose of securities premium, capital reserve? Let's say, for example, security premium. I'll read that. Security premium is used to record premium on issue of shares. The reserve can be utilized only for limited purpose, such as issuance of bonus share in accordance with the provision of Act. So in this way, you need to provide nature of each and every reserve. Okay, so this is how reserves are disclosed additionally compared to other equity in the statement of changes in equity. Again, retained earnings. Okay, then a reserve specifically represented as a enmarked for investment, enmarked investment, then it should be disclosed separately. Debit balance of statement of profit and loss account. Okay, debit balance of statement of profit and loss account is required to be disclosed as a negative figure under the head of retained earnings. Remember, negative figure as under the head of retained earnings. Similarly, other equity balance will be adjusted against the negative balance. Okay. So other equity balance will be adjusted by the negative balance, and your debit balance is required to be disclosed as a negative balance under the head of retained earnings. Okay, that was the other equity. Current, non-current liabilities. Now coming back to the liabilities and liabilities portion. So we are done with the other equity, share capital, and other equity. Sorry. This is we are done with. Now liabilities. Now liabilities again, non-current liabilities, current liabilities. The way we saw in our asset, non-current asset and current asset, in the same way non-current liabilities and current liabilities. In the head of non-current liability, you will see financial liabilities, borrowings. In financial liability, it will be borrowings, lease liabilities, trade payables, other financial liabilities. Okay, then provision, deferred tax liabilities. Again, if it is a deferred tax net liability, then you will show under the head of liability, otherwise asset. Other non-current liabilities. In the case of current, it will be financial first. Okay, which includes your borrowing, lease liability, trade payables. Okay, other financial liabilities, and then current liabilities, provision, and current tax liabilities. Clear? So financial, which includes your borrowing, lease, trade payable, and other financial liabilities. Then provision, deferred tax, and other non-current. Same way in current, financial includes borrowing, lease, trade payable, and others. After that, other current liabilities, provisions, and current tax liabilities. That is your liability side. Okay, let me discuss each quickly. Okay, non-current liabilities. Okay, in that it was financial liabilities, with starting with borrowing. Same on the line of division 1, same. Borrowing is required to be disclosed, subclassified in bonds and debentures, term loans from banks and other parties, deferred payment liabilities, deposits, loans to related party, liability component of financial instrument, and others. So this is a new we are seeing, liability component of compound financial instruments. Again, borrowing is required to be classified as secured, unsecured, and security is required to be specified in each case. Okay, guarantee to directors and others is required to be provided. Bonds or debenture, then you need to, for bonds and debenture, you need to provide in the descending order of maturity or conversion, from the fastest redemption or conversion days first, and then the coming back to the nearest one. Okay, particulars of any redeemed bond or debentures which is the company power to reissue, terms of repayment of loans, and period of amount of default on balance sheet in terms of repayment of borrowings. This will also be in Caro. This now is company reporting. In Caro we will be reporting as an auditor. Remember that. That is my loans, or my, you can say, my borrowings under the head non-current liability, financial liability. Okay, second comes to provision. Now, as the name specifies, provision is for, like, your either provision specifies provision for employee benefit, and if any other provision is there, and then your advance in other non-current liabilities, advance or others, it is there. Okay, so this is your portion for the non-current liability. Okay, so this is the portion of your non-current liability. One was the borrowing. Okay, now we saw about the borrowing. Then it's a provision that we saw. Okay, how you are required to disclose the provision. Okay, and then we saw other non-current liabilities. Now you might be wondering, where are the other items that we saw earlier? So I'll go back and show you what we discussed now. See, we discussed borrowings, we discussed provisions, we discussed other non-current liabilities, lease liability, trade payables, and deferred tax. Okay, and other financial liabilities. These are the points for which the explanation is given on the face of balance sheet itself. There is no further explanation given over below, but the explanation is given on the face of balance sheet. Okay, how? See this. Okay, okay. Now lease liabilities. If there is a lease liability respect to a lease transaction, if you have a right to asset, right to use of asset, if you have created an asset under the lease, you have a lease liability also. So the corresponding lease liability will be disclosed here. Okay, then trade payables. Trade payables we'll see for the you can say current one. Okay, the current asset, current liability, trade payables we will be seeing on the same line. On the same line, you are required to disclose the non-current one also. Okay, other financial liabilities. So it specifies on the face of balance sheet itself that other than to those specified be or to be specified, then you need to provide here. So if any item is there other than other financial liabilities, other than specified under B, okay, then you need to disclose it over here. Means it's a all-inclusive residuary heading. If there is a financial liability, okay, and if it is not falling under the head of borrowings, lease, trade payable, then you can disclose over here. Pretty much clear? Okay. Now, for lease liabilities, for non-current, you can also refer to the disclosures or the reporting requirement of Ind AS on leases. So that will give you more clarity. Okay, how a lease liability is required to be disclosed in the financial statement, because Ind AS provides more disclosure detail on leases compared to your you can say schedule 3. Remember, in start also we saw that when there is an additional disclosure requirement given in the Ind AS, we need to follow that disclosure requirement. So that is in the case of lease liability, you can say. I hope I'm clear. Okay. Okay. You can refer to para 47 of Ind AS 116 on leases. Okay, that will give you the clear disclosures on the lease liability. So that will give you more understanding on the lease liabilities disclosure. Okay. Now coming back to the rest of the schedules, notes to accounts. Now we will move to the current liability side. Just a minute. Okay. Now current liabilities, same as we saw borrowings, current liability, then financial liability. Financial liability will have a borrowings on the same line we saw in the non-current one. Borrowings, loans repayable from banks and other parties, loans from related parties, deposits, other loans. Then you need to classify between secured, unsecured, and you need to give the details of security. If loans have been guaranteed by directors, then you need to disclose separately. And period and amount of default of loan will be disclosed here. This will also somewhere come in Caro. Now, this is a new thing which is there, current maturity of long-term borrowings. Current maturity of long-term borrowings now disclosed under the head of short-term borrowings. Okay, so current maturity of long-term borrowings will be now disclosed under the head of short-term borrowings, which is of current nature. Earlier, it was part of other financial liabilities. Okay, earlier it was part of other financial liabilities, but now it is part of my borrowings. So this is an amendment you can say over here. So current maturities of long-term borrowings. Now they will be disclosed under borrowings which are of current nature under financial liabilities. Other financial liabilities. What are the other financial liabilities of current nature? Okay, when I'm saying this is current, that is interest accrued, unpaid dividends, application money received for allotment, unpaid matured deposits, unpaid matured debentures, and others. Okay, so this is how it is given. Other current liabilities was revenue received in advance, other advances and others. This is an others means like if it is not falling in any of the category, then it will fall under here. Residuary, or you can say all inclusive one. Provisions, same. Provisions as stands for first provision for employee benefit, then other provisions if you have any. Trade payables, important one, and there is an amendment. Same as division 1. What is the amendment? Earlier we were supposed to disclose based on the MSME criteria, that is still there. Okay, MSME disclosures still there. Principal amount, interest amount due, then amount of interest paid by buyers, amount of interest due and payable, amount of interest accrued and remaining unpaid, amount further of interest remaining due and unpayable even in succeeding years. That's the MSME disclosure. Other than that, other than the MSME disclosure, there is a aging also. MSME, others, disputed MSME and others, same as division 1. This is your amendment over here. Same as division 1. There is no change in this. Clear? Okay. Contingent liabilities, same as division 1. There is no change. If I say there is no change in contingent liabilities also, like claims against the company not acknowledged as debt, guarantees or other monies for which company is contingently liable, and commitment will include estimated amount of contracts remaining to be executed on capital account, uncalled liability and other commitments. Pretty much same, no difference. Again, amount of dividend proposed to be distributed by equity shares, same as my division 1. There is no change or there is no even amendment with compared to the last time. So amount of proposed dividend, you can say, to be distributed to equity share and preference shares and areas of any dividend that you are required to disclose over here. Okay, where the issue of an security made for a specific purpose, whole or part of the amount has not been used for specific purpose at the balance sheet date, then a disclosure by way of note of an unutilized amount. So for example, if I raised in equity share, raised in capital by way of equity shares, like initial public offering or following public offering for a specific expansion purpose, but I have not invested or not used that amount for expansion till now, and the amount is lying unused, then I need to provide disclosure over here. When I say I need to provide, means company need to provide. Remember, I am the company for this particular thing. When I say Caro, I am the auditor. Okay, schedule 3, I am the company. In Caro, I am the auditor. So this is the disclosure company needs to provide for unutilized amount, okay, out of raised amount raised for a specific purpose. Okay, now you can say this as an amendment. Okay, this is the again what it talks about, where the company has not used borrowing from banks or financial institution for the purpose for which it was taken. If the company has not used the borrowings from banks for specific purpose for it was taken, then company needs to provide the disclosure and auditor will provide disclosure in Caro. Okay, other regulatory requirements, again this is your part of your amendment. On the same line as division 1, remember title deeds of property is not held in the name of company, they might be held in the name of someone else, let's say director or something else. So same as division 1. Simple. There is no change. No change over here. Okay. Clear? So you can refer to the previous lecture also, where we have discussed in detail immovable property not in the held of in the name of the company, like it were held in the name of director or someone else, except for the lease agreements. Pretty much same as the division 1. There is no change. Whatever amendment was division in division 1 for this particular clause, it's same applicable over here also. Okay. Then company shall disclose whether the fair value of investment property is based on the valuation by a registered valuer. Again, same as division 1. We also discussed in division 1, remember, where the company has revalued its plant property and equipment, and the company shall disclose to whether the valuation is based on the registered valuer. Now see, in division 1, okay, in division 1, when we discussed about plant property and equipment and their revaluation, okay, we discussed about whether the property plant and equipment has been revalued by a registered valuer or it has been by the company. Okay, here in the current case it is for two things: one, investment property in division 2, plus one, plant property and equipment. Reason, because in division 1, when I say accounting standards still do not follow the concept of investment property. Accounting standards still do not follow the concept of investment property. It only follows the concept of plant property and equipment or investment. Here in India, you will see the concept of investment property, and that's why there are two separate clauses for this particular revaluation, but both are on the same line. Okay, both are on the same line. So valuation by registered valuer or not. Okay, valuation by registered valuer or no. Simple. Whether the company has revalued its intangible asset and shall disclose whether the revaluation is based on the registered valuer. Another. Now for the intangibles also, same, it will fall under the category as we saw for the plant property and equipment and investment property. On the same line. This is also will be on same line. Okay. Disclosure shall be made for loans and advances. A separate disclosure for loans and advances in the nature of loans granted to promoters or directors or KMPs and the related parties, which are repayable on demand, which are without specifying any terms of repayment. Same we discussed in division 1. Remember? Same we discussed in division 1 also. Are you remembering anything? In division 1 we discussed that, okay, amount given to KMPs without specifying terms and not loans. Remember? So here also on the same line as of division 1. So what we are required to provide is loans or advance in the nature of loans granted to promoter, director, KMP and other related parties. Clear? Okay. Then capital work in progress, aging of capital work in progress. Remember, we also discussed in the last lecture why it is necessary to provide aging of capital work in progress. Project in progress, project temporarily suspended in balance sheet date, plus Aging for the completion aging we are required to provide. Remembering something like that? Completion aging, that okay, how much time it will take more to complete the rest of the project. Work in progress completion is overdue or exceeded the cost compared to its original plan. Plus details where the activity has been suspended separately, project to be completed. Remember 3 things we discussed in previous lecture: aging schedule, overdue and suspended, plus completion. Remember something in previous lecture we discussed? Same as division 1. It will be same as division 1. There is no change. The amendment we discussed over there, the same is applicable over here also. Same for the intangible we discussed over there. Intangible, which development under progress, which has overdue is cost, and the estimated projection timeline for the completion. Same it is applicable over here also. So these all are amendments, but this amendment we have already discussed in division 1. Okay. Details of Benami property. Remember, we talked about if any proceedings has been initiated. I'm not talking about the completion of the proceedings or the company has been held guilty or not. But even the proceedings has initiated, you need to provide the details. Detail of such property, amount, details of beneficiary, okay, whether the property in the books or not. If yes, then which item in the balance sheet. If not, then the reason. And if the proceedings are initiated under this as a abettor of the transaction or transfer of the property, nature of the proceedings and the stage at which the proceedings is there. Benami property 1, same we discussed in division 1. There is no change in the amendment which we have already discussed in the division 1. Same on that line. Yes, Vidula. If okay, good question. Okay, so if any loan is becoming due, okay, if any loan which is becoming due immediately due to some default, where you will disclose that loan. Remember, you need to apply the classification which is given for the definition given for the current and non-current. If after applying the definition it's still current, you need to show under the current. Jay, can you refer any clause or which we were talking about with respect to the guarantees? That will be helpful. Yes, Jay. Proposed dividend are finance part of notes to account. We disclosed that. I'll show you one live example also after this. Thank you, Vidula. Yeah. Okay. So same Benami property that we discussed in division 1. There is no change. Now, whether the second is whether the company has borrowing from financial and banks and financial institution on the basis of security of current asset. If yes, then whether the quarterly returns and statement are in agreement with books of account. If no, then summary of reconciliation. We have also discussed this one. We have also discussed this one in division 1. Same. There is no change. You might be wondering why the amendments, same for the NDS and the AS. Reason because these amendments are on the basis of some logic and to, restrict some mischiefs or issues in reporting point of view. So if you have an issue in division 1 reporting, it will be there in division 2 also, because they are on the base of some past mischiefs, or you can say past problems that it was faced for the financial reporting. Okay. So that's why they are same in division 1 and division 2, because the logic, underlying logic remains the same. If you see the underlying logic, it remains the same. Willful defaulter. Same. There is no change even in the willful defaulter. For willful defaulter, if we have been declared by any bank or financial institution or other any lender that the company is a willful defaulter, then the date of declaration and details of default. Okay. And willful defaulter means when, as per the RBI guidelines, any bank has declared as a willful defaulter. Relationship with stock of companies. We need to provide the relationship with the stock of companies. We discussed in the last lecture also, that how we are required to disclose the relationship. Okay. So if there is a stock of company and we were having any investment, receivable, payable, share held by that stock of company in our company, or any other balance with that stock of company, then we need to provide that detail over here. If there is pending registration of charge or satisfaction of charge with ROC, we need to provide details that of. Again, same. Registration charge or satisfaction of charge with ROC. Compliance with the number of layers, same as division 1. What is compliant with the number of layers of company? If you have, there is a provisions, clause 87 of section 2 plus the company's restriction of layers rules. If you do not comply, then you need to provide the name of and sin of the companies beyond that number of layers. Remember, we discussed in last lecture. Same. Ratio analysis. All the ratios are same as division 1. Remember, we are also required to provide numerator, denominator of each ratio, how we are calculated. Okay, so numerator and denominator of each ratio that has been disclosed, we are also required to provide that we discussed in last lecture. Remember how we are calculating? I took an example of net profit ratio. What I'm taking as a net profit after tax, before tax, what is the turnover, total turnover from operating, you can say operations, continuing operations, or from discontinuing operations also. Remember something we discussed in last lecture? Same on the line of division 1 that we discussed. If there is a change of 25% compared to preceding year, you need to provide reason thereof. Same. Compliance with this approved scheme of arrangement as division 1. We also discussed if there is a scheme of arrangement, how we have disclosed in the books of account, how it has been accounted for, any deviation from accounting standards, prescribed accounting standards for scheme of arrangement, same as division 1. Utilized addition of borrowed fund and share premium. Okay. Remember, we took an example of X, Y, and Z. When we were X, we were funding party. We were Y, we were intermediary party, and Z was the ultimate beneficiary to whom the money was given, directly, indirectly, guarantee was given. Remember, we discussed the example in last lecture. Let me show you this one. Remember something we discussed in the last lecture? We are X limited, anything from the last lecture? X limited, Y limited, Z limited, X limited, Y limited, Z limited. We were now in the second clause. In clause B, we were the intermediary. In the clause A, we were the funding party. We gave the loan of 3 crore, something we discussed in the last lecture. Same is there in the division 2 also. If you have the clarity of division 1 on this point, then you have clarity of division 2 also. There is no change. Same as division 1. that we discussed. There is no change. Remember, we need to provide the details of loan given or invested in such other intermediaries, and guarantees, plus a declaration of FEMA, Companies Act, Prevention of Money Laundering Act. Same line, no further change. This is a clause B, where we were at the intermediary. Funding was coming from someone else, we were passing on the funding. Same, and plus a declaration. Clear? So this is same as my division 1. No change. Okay. Something with respect to my, you can say, retrospective restatements. Okay. If a company applies a accounting policy retrospectively or makes a restatement in the financial statement, or when it reclassifies the item in financial statement, the company shall attach a balance sheet at the beginning of the earliest comparative period. Remember, as we so what is done is, when you restate an item or you apply a accounting policy retrospectively, then what you need to do is, I'll show you. You need to present 3 balance sheets. Balance sheet as at 1/4, let's say 19. Balance sheet as at 1/4, not 1/4, sorry, 31/3/20, and balance sheet as at 31/3/2021. So this is my comparative. This is my beginning of the comparative, and this is my current reporting period. Clear? This is how we are required to give 3 balance sheets for restatement. Okay, this is how you are required to disclose for the restatement, retrospective restatements, basically. So the word used here is accounting policy retrospectively, applies an accounting policy retrospectively, makes a restatement in financial statement, or reclassifies items in the financial statement. Clear? Okay. Then it talks about share application money. Now share application money pending allotment, share application money pending allotment shall be classified into equity and liability in accordance with the Ind AS. So you need to see Ind AS for classification of share application money pending allotment, whether it will be equity or liability. Equity, it is there. Okay, the money, share application money, to the extent not refundable, shall be shown under equity, and share application money to the extent refundable shall be shown under the head of other financial liability. Okay. Same way, my preference share, including premium received on issue, shall be classified as a equity or liability as per the Ind AS. Simple. Okay. So there are various things you need to take care while classifying the equity portion or liability portion of the preference shares. You need to refer to the Ind AS for this further classification. When I say if it is a liability, then you need to show the liability under the head of non-current liabilities, borrowings. Okay. Again, compound financial instruments such as convertible debentures. You are required to split the equity in component portion, liability components of that particular compound financial instrument. You need to see the relevant Ind AS for the bifurcation. How you need to bifurcate between equity and liability. So these all three items are bifurcation of equity and liability portion. Okay, So share application money, preference shares, and compound financial instrument. Regulatory deferral account balances shall be presented in balance sheet in accordance with relevant accounting standard. So that was my part 1 of division 2 balance sheet. Okay. Now part 2, which is statement of profit and loss account, pretty much easy and on the same line we saw on the division 1. There are few changes. I will be discussing that. Okay. So revenue from operations, other income, then total income, then expenses. We saw cost of material consumed, purchase of stock in trade, changes in inventory of stock in trade, finished goods and work in progress, employee benefit, finance cost, depreciation, then exceptional items, profit before exceptional items and tax. Okay. Then tax expenses, profit and loss for the period from continuing operation, then discontinued operation, tax from discontinued operation, then profit and loss from discontinued operation, then you say profit for the period. Now there is a change. OCI, other comprehensive income, which was not present earlier, but it is present over here. Items that will not be reclassified to the profit and loss account. Income tax relating to the items that is not classified as the profit and loss account. Items that will be reclassified to the profit and loss account, or income tax relating to items that will be reclassified to the profit and loss account. There are list of items which fall part of OCI. Okay, you need to check relevant accounting standards Ind AS for that, which item is required to be disclosed as a OCI or not. Okay, then once you have a total OCI, this is total OCI plus your profit. Okay, now other comprehensive income and profit, if you add both, you get this total comprehensive income for the period, include and other comprehensive income. Okay, then you show earnings per equity share, basic and diluted, from continuing operation, from discontinuing operation, and from both. So this is again different than division 1. In division 1 we were only showing 1 EPS. Now we are showing 3 EPS, continuing, discontinuing, and total. This is different from your, you can say, division 1, and this is different from division 1. I hope I'm clear. OCI and EPS, both are different. Both are detailed disclosures which were not present in division 1. Okay. Rest all same we discussed. Okay. Statement of profit and loss shall include 2 portions: profit and loss for the period and other comprehensive income for the period. This was not there in division 1. This is only specific to the division 2 Ind AS 1. Okay. Same my revenue as division 1. Then finance cost, same. Other income also same. Okay. Other comprehensive income. List of other comprehensive income shall be classified into items that are not to be reclassified to the profit and loss account. Now this is something different and a change which was not there in division 1. This is important, I'll say. Okay. So this is a list of items of OCI. Changes in revaluation surplus, remeasurement of defined benefit plans, equity instrument through OCI, fair value changes of own credit risk of financial liabilities, shares of other comprehensive income of associate and joint ventures, okay, and shares of other comprehensive income in associate and joint venture extend not to be classified from profit and loss account. I'll suggest for each of this, for each of the item, you need to refer to the respective Ind AS for to understand the detail of about the item. Refer Ind AS for to understand the detail of the item. Exchange difference. Now, sorry. Now this is the point B, that was items to be reclassified to profit and loss account falling part of OCI. Okay. So exchange differences, debt instruments through OCI, effective portion of gains and loss on hedging instruments, shares of other comprehensive income of associate and joint venture to be extend classified into P&L. Clear? Okay. That was OCI. That is something different than my division 1. Okay. Other than that, same again. Same as division 1. Now here, this limit, materiality. Remember, any income or expenditure, which is either 1% of the revenue or 10,000 or more, or 10 lakh or more, whichever is higher, is required to be disclosed separately. Materiality concept. In division 1, when we were discussing this particular limit, okay, in division 1, when we were discussing this particular limit, that limit over there, let me show you. That limit over there was 1 lakh rupees, 1 lakh or higher. But for the division 2, this limit is 10 lakh rupees. So for division 2, this limit goes like changes for compared to division 1. So for division 2, this limit tends to 10 lakh rupees. Clear? So there's a change in the limit for the division 2. Sorry, sorry for this. Okay, this is a change we are talking about. Clear? Any doubt on this? Any doubt? Any doubt, guys? Okay, no, then let me move forward. Correct, Vidula. Okay. So these items, rest of the items like interest income, interest expense, net gain and loss, same as my division 1 is there. Okay. Payment to auditor, same as division 1 is there. Undisclosed income. Remember, if there is some undisclosed income that we are required to disclose, same as division 1. CSR disclosure, same again. Then it comes to details of cryptocurrency, same as division 1. This is something different over here we are talking about now. Changes in regulatory deferral account balance shall be presented in statement of profit and loss in accordance with the relevant accounting standard. If there is any regulatory deferral account balances, then you need to disclose the same as per the accounting standard, relevant accounting standard. That is subjective and case-to-case basis, which is not applicable in case of NDS. So this is different. Okay. Part 3 is generally for the consolidation of consolidated financial statement that we'll discuss when we will discuss the consolidated financial statement reporting. So this was division 1 and division 2. Again, division 2, part 1, part 2. Any doubt till now for division 2 also? Any doubt, guys? Okay. So yeah, this was the particularly disclosure for division 1 and division 2. Okay. Most of the amendments are same in the division 1 and division 2, except for a few changes that are marked as of now. And I also suggest you mark in your module or study material that will help you in revision at a later point in time. Okay, so that was how a financial statement are required to be disclosed as per schedule 3. Now for the next topic, what I'll take up is we will link Caro with the schedule 3 reporting. Now we'll understand what is how in Caro 2020 we are required to report, plus to whom the Caro 2020 is applicable. So we'll be starting now with Caro 2020. Okay. Okay, now, so we are starting with a new topic, which is Caro. This topic is linked with my schedule 3 also, because we will see how, okay, what are the points that are similar between the amendments of, you can say, my schedule 3 and Caro 2020. Okay, so there are amendments which are present at both places. So we'll see both of them. I'll link at the same time. But before going to the clauses of the Caro 2020, first understand to whom it is applicable. To whom it is applicable and to whom it is not. Okay. So from applicability point of view of Caro 2020, I'll say the following classes of companies are exempt. Following classes of companies are exempt. So okay, just a minute. So these are the classes of companies which are exempt from Caro 2020. I'll tell you an easy way to remember this. Okay, easy way to remember this. Simple. BIOS 8. Remember in computers we see this terminology, BIOS, basic input output software system. Okay. Now what are these? What is this for? B stands for banking company. B stands for my banking company. I stands for my insurance company. Okay. I stands for my insurance company. O stands for my OPC. S stands for my small company. Okay. Small company. 8 stands for Section 8 company. So banking, insurance, OPC, small, Section 8. Caro is not applicable. Caro 2020 not applicable. Clear? Now there is one more class of company to whom the Caro 2020 is not applicable. That is plus private limited. But there are conditions for private limited companies. The condition goes like P1, D1 and R10. So if these conditions are satisfied, then the Caro is not applicable. Which are these conditions? That is paid up. Okay. Paid up share capital plus reserve and surplus. Reserve and surplus less than rupees 1 CR. That is P1. D1 again, debt या borrowings should not be less than 1 CR. Borrowing should be less than 1 CR from bank and financial institutions. And R10. R10 is my revenue, total revenue. Total revenue including discontinuing operation, okay, of during the financial year should be less than rupees 10 CR. Okay. So if the total revenue is less than 10 CR during the financial year, if the debt during the financial year, okay, during any point in the financial year is less than 1 CR and paid up share capital or plus reserve and surplus at the balance sheet date is less than 1 CR, then it is not applicable. P1, D1, R10, simple. For private limited companies, this is a, you can say, easy way to remember to whom Caro is applicable. This is at balance sheet date, any point during year, or you can say any point. Clear? To these companies, Caro 2020 is not applicable. To other than this, to everyone, Caro 2020 is applicable. I hope I'm clear. Okay, let's take an example. Let's see, did you get it or not? Example. Okay, now I'll take a wonderful example. ABC Limited. Okay, ABC Limited. Sorry, just give me 1 second. Okay, now first of all, before going to the in detail, okay, we'll take an example. Okay, now in this example, what we are discussing is a company where to whom, whether the company to that company Caro is applicable or not. Okay, so let's take an example. Let's say ABC company. Okay, Now ABC company, ABC Limited is a company involved in involved in trading of goods. I'll say ABC Private Limited is involved in trading of goods. Okay. Now during the year, the turnover of the company was rupees 9 crore. Okay. Number 2. On now we are talking about here financial year 21-22. Okay. On 1/4/2021, borrowings were from the following parties, like following parties were present. DEF Limited, Bank A, NBFC B. Okay, so these were the three parties from where we were having borrowings as on 1/4/21. That is rupees 40 lakhs, rupees 60 lakhs, and rupees 10 lakhs. Okay, total rupees 110 lakhs. Now on, let's say during the year, let's say 31/12/2021, the borrowings that we are talking about from DEF Limited, okay, from DEF Limited, it went to from 40 lakhs, it increased to rupees 60 lakhs. From Bank A, the borrowings from 60 lakhs, it decreased to, let's say, 50 lakhs. So there was a decrease from borrowings from banks. And from NBFC, again, there was a decrease from borrowings. Now it was earlier 10 lakhs, now it became your borrowings of rupees 5 lakhs. So the total, which was earlier 110 lakhs, now the total is rupees 115 lakhs. In total, the borrowing has increased. As on 31st March 2022, okay, borrowings from DEF Limited, okay. Now let's say DEF Limited, what we are talking about is a holding company. Not holding, or let's say shareholder. It's one of shareholder. Okay. Borrowing from DEF Limited increased to 70 lakhs. Borrowing from banks has decreased to 25 lakhs. And borrowings from NBFC has again increased to 15 lakhs. My total goes to rupees 110 lakhs. Now, as per the provision, okay, as per the provision, let's say this is a private limited company involved in trading of goods. During the year, turnover is this, and another condition for paid up share capital. Okay. Is let's say paid up share capital 80 lakhs. Now you tell me whether CARO 2020 will be applicable or not in the current case. Whether CARO 2020 will be applicable or not. Simple. This is a scenario for my borrowings. You tell me whether Caro 2020 will be applicable or not. Come on, guys. Pretty much easy. There is no difficult thing in there. So Caro 2020 is applicable or not? Come on, guys. Borrowing greater than 1 year. Okay. Priya, you are talking about borrowing greater than 1 year or less than 1 year. Correct, Jay. And why? I'll also like to hear the reason why it is not applicable. This is very crucial to understand. Very crucial to understand, guys. Why it is not applicable. So it is very important to understand, guys, why it is not applicable. Come on, guys, pretty easy. Whether correct, Jay. Correct, Srinidhi. Yes. Okay. So in the current case, we will not calculate the borrowing from DEF because DEF is not a financial institution or a bank whose borrowings are we are required to calculate. Clear? Okay. So Caro 2020 is not applicable to a company whose borrowings does not exceed 1 crore from any bank or financial institution. DEF Limited is not a financial institution. So to this company particularly, borrowings is within the limit and hence the Caro 2020 will not be applicable. Clear? Okay. Now, if I change a bit, I'll change a bit and let's see then whether it will applicable to not or not. Okay. Let's say this is 70. Okay. During the year it went to 80 and this went to 10. This was 15. This was 5 only. So my total will change. Okay. 60, 70, 35. And here 160. Okay. And let's say, for example, in this case, we have a this will become my, let's say this is a holding company. For simplicity, I'll keep this is a holding company. Okay. And let's say I'll change over here. Instead of trading of goods, service provider. Okay. Turnover, I'll reduce it. I'll say turnover is 5 crore and this will become, let's say, 90. Now tell me, whether Caro 2020 will be applicable or not. Now the company is into the service provider role. Okay, turnover is 5 crore rupees, not more than that. Paid up share capital is 90 lakhs. Now the borrowing has been changed over here. Okay, this is the borrowing we are talking about as of now. Now you tell me, Caro 2020 will be applicable or not? In the revised example, Caro 2020 will be applicable or not? Come on, guys. Pretty simple. Caro 2020 will be applicable or not? Come on, guys. So now the company is a service provider, paid up capital 90 lakhs, turnover 5 crore, and the borrowings is on your screen as on the position. You tell me Caro 2020 will be applicable or not? Come on, guys. Pretty simple. Trust me. I'm waiting for your answer. Okay, Srinidhi. Jay, Priya, Vidula. Come on, I'm waiting for your answer. Kuldeep, Priya, come on, try to answer. Okay. Come on, guys, I'm waiting for your answer. Come on. Okay. So people who are saying answers same as before or it will not be applicable, you are incorrect. The reason because a simple change, holding of DEF, it's a subsidiary of public limited company. So as per Caro 2020, in case of private companies not being a subsidiary or holding of public company, the rule is not being subsidiary and holding of public companies. So when I say private limited, it is not a subsidiary or holding of public. If it is not a subsidiary of holding in public limited, then only I will go and check the rest of the conditions. Otherwise, I will not check the rest of conditions. It is directly applicable. In the current case, when I say DEF Limited is a holding company, directly irrespective of the conditions, Caro 2020 will be applicable. Clear? Any doubt? Any of the doubt? Understood? Jay, Vidula, Srinidhi, Priya, Harshad, Kuldeep, are you getting my point? So the conditions are for the private limited, if the private limited is not a subsidiary or holding of public limited company. Otherwise, it is applicable. I'm only required to check the paid up share capital, debt and turnover terms and condition when it is not a subsidiary or holding of public company. If it is a subsidiary or holding of public company, irrespective of the conditions, it is applicable. Irrespective of the conditions. Understood? Am I clear? Good question, Murali. Whether the NBFCs are also covered under the exemption from applicability of CARO. Now, if you see the exemption which is provided in the CARO, it talks about a banking company defined under Clause C of Section 5 of Banking Regulation Act. When I talk about the MBSC can be defined under Section 45 of the 45 IA, if I'm not wrong, of RBI Act. Okay, so from the plain reading, it talks about only banking company, not the MBSC. So still for the NBFC, it will be. So exemption is only to the companies defined under Clause C of Banking Regulation Act, which is banks or financial institution. If you see the definition, it includes banks. Okay. Correct. Absolutely correct. First check whether it's a holding or subsidiary. If not, then only go to the rest of the criteria. Now, just quickly, I'll take up one more question. I'll just bit of change it. I'll remove this holding. Okay. Let's say DEF is not a related party. Not related. Okay. I'll change up some of the metrics again. Let's say remove this 70 and 5. Let's say this was 60 and from NBFC it was 40. Not 40. Let's say this is 70. The total borrowing. Okay. Let's 170 lakhs. Let's say this is same. So this 70 to 80 increase, but this 40 to 10 decrease during the year. So as of closing, 160 is the balance. So this is same. Okay. And one more condition I'll change over here is, let's say this is not 5, but this is 2 CR. Okay. ABC Limited is involved in service provider and is small company. Okay. So ABC Limited is service provider, small company, paid up share capital 90 lakhs, turnover less than 2 CR. Okay. And these are the borrowing conditions. Borrowing as on 1/4/21, 110, as on 31/12/21, 170, as on 33/20/22, 160. This is the configuration of borrowing. Now I am saying DEF Limited is not related to me. Now tell me whether still it will be applicable or not. This will be applicable or not? You tell me. Come on, guys. Correct, Vidula. Correct, Priya. Correct, Jay. Correct, Jay. Okay. So yes, this will not be applicable. Reason because what I need to first check is whether it is from this category or not. First, I'm required to check BIOS 8. If it is BIOS 8, directly out, not applicable. Even though if it is satisfying the conditions of private limited or any other company. Now here it is a small company, part of BIOS. So I'm not required to check any of the conditions. any of the condition, because first I'll check for BIOS, then if not BIOS, then check for private limited. But before going to the private limited, I'll check subsidiary or public, and then the rest of the conditions. Clear? So here it falls under the small company, irrespective of the categories of the private limited, it will not be applicable because it's a small company as per the definitions of Companies Act. I hope I'm clear. Any doubt, guys? Any doubt? So guys, this was basically the applicability of the CARO 2020. Very important to understand, because once you decide what is applicable, when if CARO 2020 is applicable or not, then only we can proceed further with the clause. So this was basic about the applicability of the CARO 2020. Any doubts till now? Any doubts till now? Yes, they include, but I'm not talking about on this point. At times, some people, at times, because of the complex transitions, okay, let's say, complex accounting structure, it may happen that it is not including, but usually it includes. You are correct, it includes usually. So my point was over there is, if one of the item in the balance sheet, let's say for example in trade payables or trade receivable, the aging amount should match with my item or number which is presented in the balance sheet. So if balance sheet is showing trade payable or trade receivable as 100, then you are required to disclose the aging of rupees 100 only, not 110 or not something else amount. So that was the point over there. Any further doubt, guys? Guys, please provide your feedback, and it's very important to understand that what you require additionally, or which details you require additionally. It is very important for us to understand. Please provide your feedback. Please study Schedule 3 and CARO carefully. Go through what we have discussed over here, and or for the next lecture, please go through CARO 2020 also and their clauses. It is very important. If you have read it earlier, then you will be able to ask question, you will be able to understand in details, and it will be more helpful to you. Also, for what we have discussed till now, study, go through, and if you have any questions, please come back in the next lecture, ask it. I will be happy to discuss. In exam, if you see, Schedule 3 and CARO both are important topics. In exam, both are important topics because both cover a good amount of marks. So I'll suggest please read these things because they are very important topics. And if you see, these contain a lot of amendments also. So if I talk about CARO usually goes to a very important topic because it is not only related with the like you can say one of the chapter, but it is interrelated with the now Schedule 3 also based on the amendments. So it's very important. So please guys, read CARO 2020, Schedule 3, and let's meet in the next lecture for discussing the rest of the CARO. Okay. Thank you guys. Thank you for being participating in today's lecture. Thank you.